Welcome back, everybody, to the Informed Home Buyer Podcast. I'm your host, Rich Curtis, and I have with me my co-host and lender extraordinaire, Dave Miller. Hey, Dave, welcome.
Hey, Rich. Thanks for having me. Looking forward to it.
So today we're going to be talking about why mortgage payments in California look so high and why when you go online and calculate your own mortgage payment, you're getting a lower number. And then when you call Dave and I and we calculate it all out for you, you're getting a bigger number. It's blowing your hair back. What's the discrepancy there? And it all comes down to the assumptions that are built into these online mortgage calculators. So today we're going to teach you how to change those assumptions to make them correct and accurate for yourself so you can, on your own, figure out accurate, full mortgage payment so you can start to budget and plan with real numbers. If you have any trouble with this, of course, we're always happy to help. But by the end of this video, you should be a pro at going online to any mortgage calculator you want and figuring out your accurate payments from there. Now, your payments are broken into 4 sections. It's a PITI, payment, principal, interest, taxes, and insurance. So at this point, I am going to hand the ball to Dave and let him explain what all that means. Dave, can you break down the PITI payment for the listeners?
Yep, sure can, Rich. And so what I'm going to do first here is, as I'm talking, I'm going to begin to share my screen, and we're going to talk about PITI and making some assumptions here. And I'm going to do this for you right now. I am going to be sharing a mortgage calculator, and I'm ready for you to pull it up, Rich, when you're ready.
All right, perfect. There we go.
Yep. Okay. So I'm going to go ahead and make some assumptions. And if you've seen some of our previous videos, we typically use a home price right around 500,000.
Wait, before we start going granular,
Yeah,
can you just define PITI for them? Like walk them through the 4 components just so they have a sense of what you're putting in and why.
Yeah. In fact, well, let me just refresh this too, because yes. So I'm going to just get on the mortgage. So when we're talking about PITI, we're talking about principal, interest, taxes, and insurance. And so there's going to be, as you mentioned, 4 components to that. And that's what's used to determine your total mortgage payment, your mortgage debt. And there could be other components to that as well. Things such as mortgage insurance, which is we will just briefly touch on, and homeowners association, if there's one of those as well. So those are included in your homeowner's debt. And there's one other piece too that can affect is if there's solar on a property, a solar lease. So there's all kinds of moving parts and going to be dependent on, the insurance, the HOA, all of that stuff is going to be dependent on the location of the property. Does it sit in a HOA community or not? And is there obviously solar or a solar lease, something to that effect on the property? So a typical consumer, when you want to find out what you qualify for, and we'll make some assumptions as well, is if you're looking at this online mortgage calculator, you go to an online mortgage calculator, and this is going to make some assumptions. So say you're looking for a $500,000 purchase, you put that in. It's going to say 20% down. It's going to say 30-year fix. It's just going to pick an interest rate. We'll just stick with what's on the screen here. And this is going to show your payment of $29.23. Now, there's some additional information here. So this is showing, okay, I got principal and interest of $2,600, $105 insurance, and $213 for taxes. This all seems pretty reasonable at $29.23 payment. Well, once we get down and we uncover some misconceptions here on these online calculators, as I scroll up here, is they're making some assumptions that aren't accurate. So for example, property taxes, they're using a 0.51% rate. So where, California, we use a 1.25% rate as a starting rate to calculate this and qualify. So that instantly jumped to $62.50 a year. You can see your payment increase. Then another caveat here, and you've seen some of our presentations on insurance, that $1,260 is probably pretty darn low, depending on where we're at, where you're looking to buy, the type of insurance that's available, who's writing policies. So that's again where you're going to want to have a conversation with your trusted agent and lender. So we're probably going to double this just for a starting point. So we're going to say $2,400 a year. We'll say no HOA dues. And now all of a sudden we went all the way up to $3,326.
Yeah, that's a big jump. And depending on the community you're in, we're not even accurate yet. So Dave made an important distinction when he changed the taxes from 0.51 to 1.25. Our primary market is California. We're in Northern California. We work mostly in El Dorado, Sacramento, Placer, Amador, Nevada counties. So in California, in the areas we work, 1.25 is a reasonable assumption. Your actual ad valorem tax rate, which is ad valorem's Latin for basically your standard base tax rate, is 1%. But you always have a bunch of other little ticky tack stuff, $25 for the library, $50 for the schools, $100 for the ambulance, whatever. All of those little special assessment taxes, we lump them in with a little buffer of the 0.25 there to get closer to what your accurate taxes will be. Maybe somewhere in the country, if you're watching from somewhere else, welcome. We love to have people who aren't in California listening too. That's great. 0.5 might have been right for you. We're going to put in appropriate assumptions for our primary markets. If you're not in our primary markets, reach out to your trusted professionals, get the right numbers. If you are in our primary markets and you're still having trouble, reach out to us and we'll get you the right numbers. But that 1.25, that's going to be accurate for all the markets we work in California. But that home insurance, that might be good for Folsom. That might be good for like Rancho Cordova, downtown Midtown. I think, in Sacramento, we could get some of that, but anything, up the hill, Cameron Park, Placerville, El Dorado Hills, we're gonna have to go higher from there. So I'll let Dave pick it up again and play with some other assumptions here to show you how that payment's gonna jump up quick.
Yeah, and so we saw this payment increase. I think that's about a $400 increase from where we started. Now, it's really important to know. So when we look at payment here, there's two different components to looking at a mortgage payment in terms of, okay, our DTI, what do you qualify for and what are you comfortable with? And so for us as your trusted advocates, we always want to make sure we're putting you in a situation where you're comfortable with a payment. We don't want to, extend you beyond what you're comfortable with. So starting with accurate numbers is really key here. So
Yeah.
what can you do, to lower this payment if you choose? And if based on the area you're looking, you may want to change your sales price a little bit. We could talk about lowering your interest rate, what affects your interest rate. Typically, an eighth of a percent in interest rates only at a $500 or a $400,000 mortgage here is only going to drop you maybe $30 a month. So it's not really significant. So there's other ways, so that we will help determine, what your comfort level is and what are your other debts. So you may have, when we look at your debts, we're going to see what's on your credit report, which is going to include things like student loans and car payments, installment loans, minimum credit card payments. That's going to show up. Those are debts that you're used to paying. And then we'll also ask some questions about, okay, when you buy this home, you see these expenses here. These also don't include some utilities that you're going to pay, but are not qualifying factors in your debt to income. So if you're going from maybe a house or apartment where you're not paying PG&E or SMUD, you could see a significant increase in your monthly expenses. So we'll make sure we mention these things to you. What does that dollar amount look like? And that's typically going to be based on where you're buying. Is it SMUD? Is it PG&E? It's based on the property size, maybe the age of the home, the energy efficiency of the home is all going to have factors on those expenses. Other things like water, garbage, where you live will have an effect on that. But as a mortgage lender, we don't use those for your qualifying, but we will mention those things to you as your trusted advocates to know that, hey, you buy this home, there's some other expenses. So if you rent, yep, go ahead, Rich.
Oh, no, that's a really good point. And they're not reflected in the payment. So when people are making a transition from living at home to purchasing a house, or from an apartment or any kind of rental situation where those water and garbage are paid, that your payment doesn't reflect the total cost of home ownership. So getting your payment right to start with is good, but when you're evaluating your actual payment comfort, we can give you an idea of what those utilities are going to be in the area, so that we may have to adjust the purchase price down to bring the payment comfort in line to account for all the additional costs that you maybe have never in your life had to pay as a renter. So I think that's a really key point, that we are only today talking about the four components of principal, interest, taxes, and insurance of the payment. We'll do another whole podcast for you. I think that's a great idea, Dave, on total cost of home ownership and how to kind of work your way back into your payment comfort while evaluating all the costs of living. I think it's a great idea.
Yeah.
Before we move on, can you walk us through, insurance in like a Placerville area is going to be a minimum of 5,000 to 6,000 a year, and can easily get 9,000 to 10,000 a year. So can we play with a couple homeowners insurance assumptions
Yeah.
and
So
show them how that affects payment?
I will double this and go to 4,800. If you notice, your total payment just went from 33.26 to 35.26. So that was a $200 a month increase in your payment. And so for someone that's ready to jump in the car and go out looking, and one thing I could say for Rich is your knowledge base, Rich, you could drive a half hour with clients in your car and have a pretty good idea as you drive down the hill how much their insurance may change, or based on the
Yeah.
disposition of the property, the type of property, where they're looking to buy, a ballpark. So, I know, Rich, we've been doing this a long time, and how many times you've said, hey, I'm getting ready to show a property. Here's this location. Make sure they know their payment. What are you using for insurance? And
Yeah, and I think that's a crucial question for everybody out there. Because sometimes people go to the lender first. The usual process, they reach out to a realtor because it's more fun to look at houses than it is to talk about money and paying bills. So often someone will come to me first, and then I'll refer them to Dave to talk the loan parts. But sometimes they go to the lender first, and if some of these lenders cover wide areas. And if they're not, Dave's local, he lives here, he works here, he knows the numbers inside and out. But if you're working with someone, that's at more of a 800 number call center, big bank type of thing, and they just might not know that, there's only a few miles difference from Folsom to El Dorado Hills. And to them on a map, it doesn't look any difference, but the insurance costs, doubles or triples over those couple of miles. So that is really crucial that you're getting this stuff right. 4,800 for most everything in the foothills. In our mountain markets, you're talking an Auburn, a Cool, a Garden Valley, a Placerville. That 5,000 mark is probably the bottom. And if you're on a larger house, larger acres in a higher fire prone area, 10,000 isn't unusual. So not to scare anybody, but let's throw $9,000 in there and just see the swing this makes.
yep, so that went all the way to 38.76. So from our original amount,
2,900.
yep. So basically, we are up. That's about $500 more a month than where we started. I mean, that's significant. And so not only
500 more than the last one, but almost 1,000 more, I think, than we
yes,
started. Yeah, almost 1,000 more than when we started, And look at you see the two different colored blue lines. There's three different colored blue lines on the screen. Notice how much larger the dark blue insurance line is as part of the screen, right? So now if you're in a Folsom or a downtown Midtown where that 1,400 estimate was accurate, your insurance was a very small portion of that. Yeah, you can show that again. Dave, put it in, throw the 1,400 in just for
yeah.
kicks and grins.
I think maybe we started even with 2,400. I think we started.
But yeah, look how
Yeah.
much your insurance portion of the payment shrunk. So
Yep.
by living in any of these fire prone rural, or wilderness, areas that we have a lot of in our primary markets, the portion of your payment that it accounts for insurance goes from this much to this much. On the scale. So you can see you might have been at home calculating a payment, and it actually could be $1,000 more a month than you were calculating. And the way the psychology of this works is most people aren't out there calculating like the super most comfortable mortgage payment they can make. Most people are already kind of maxing this bad boy out, going as, could we stretch? Could we make this payment? Because they want to get the nicest house they can. And I totally get it. So if you've been kind of playing with your max numbers and it goes up by $1,000, that's going to change dramatically the amount of house you can buy. So if the payment swung by $1,000 like that day, like how much less house would we be looking at to try to bring the payment back down $1,000?
Oh, shoot. You're looking at, you're looking at over $100,000 in purchase price.
Yeah.
So,
So by getting this wrong online, you could be thinking you're shopping at the median. We're giving you the median for Sacramento. It's also the median for Placerville, $515,000 median home price. You can think I'm shopping the median. And if you were using these online mortgage assumptions, you've maxed out your mortgage payment, you're shopping at the median. I get a pretty good home for this. Then it jumps up $1,000, and now you're shopping at $400,000. And the quality difference, if I walked you into a $400,000 home and a $500,000 home, it is worlds of difference in terms of quality in our primary markets. $100,000 in purchase power makes a big difference. So you can see how getting this wrong at home really sets you up for some heartache and some disappointment in how far your money will actually go.
Yeah. And I think part of that's too, Rich, is making sure before you go out and you start looking and touring properties, which I know we're very cognizant of, we make sure that you have a general idea of the number. The last thing we want you to do is walking through a home, falling in love with it, and then finding out that, not only is it $500 or $1,000 outside your comfort zone, but you no longer qualify for that property. So we want to make sure we're realistic with what we're looking at. Now, the other component to this is when we're looking and you say, okay, well, maybe you rent for, $2,500 a month or whatever that may be. And so you're willing and you've been saving money, you've saved, 100,000 for down payment. And if you have some consumer debt or some other debt that is keeping you from qualifying, there are other options for us to get you to qualify if it's going to be a short-term fix. So what I'm referring to here is a lot of folks, so I look at two ratios when we're qualifying you for a mortgage. We're looking at a top ratio, which is your housing expense compared to your income. So your potential housing expense. So I'll go more to a realistic number here. I'll just put in 3,600 here and say we're somewhere in the middle of the road. So if we were using this $3,400 number, if your income was, $7,800 or $6,800, we'd be saying, okay, well, your housing expense is 50% of your income. That's your top ratio. You're not going to qualify for this. Now, if you make more money, we want to see your front ratio typically under 40, and your bottom ratio, depending on credit score, some other things, we can see that go a little higher if you have a fair amount of consumer debt that looks like you can get rid of or fall off. That might
And
be
what
things.
comprises that bottom ratio, Dave?
The bottom ratio is going to be a combination of the monthly payment debts that show up on your credit report, things such as student loans, minimum credit card payments, installment loans.
Gotcha.
Anything that's going to show up on your credit report with a monthly payment is going to affect that bottom number. And, and I'm working with some clients right now that interesting is their top number is 30 and their bottom number is 49. That's a big swing, right?
Yeah.
So they're willing to stretch and go up to a 49 bottom ratio because they have, for example, an automobile payment that they owe $10,000 on, and it's a $700 a month payment. But that's going to go away in a year and a half. So now all of a sudden, so we look at those types of things and say, okay,
Yeah.
or if we can eliminate that now. So if you look at this $100,000 number here, you've saved just enough to put down payment. And we say, okay, well, maybe you don't want to put all 20% down. Maybe you want to put a little less down. And we'll say, okay, let's put 80,000 down. Put 20,000 less down, 16% here. Okay, so your payment jumped up, and I'm going to change this number again here so you can see what your payment did. There's another component to this. Let me just jot this number. I'm going to go back to 100,000 down. So we're at 3425. And then I will drop this down to 80,000. So we go up to 3710. So, 290 something bucks, 290 bucks roughly, is a payment for 20,000 less. But if you could use that 20,000 to eliminate that $750 a month auto loan, you've just freed up $500 a month, and you're doing it now instead of later. So
and saving yourself interest too over the next year and a half on that particular.
That is correct. Yeah, that is correct. Now, not exactly apples to apples, because when there might be other, if I'm going to go in here, there might be, now that you've put less than 20% down, depending on credit, there's going to be a small mortgage insurance piece. And in this scenario, that might be like $40 a month, based on credit score. So I would always be able to figure that out for you. Your mortgage lender should be able to figure out that for you. So, so we just, did 295 plus 40. So, a little over $300 goes more towards your mortgage, but you eliminated $750. So there's still $450 freed up. And now all of a sudden you're like, oh, that's great. I'm comfortable with this. And we get you to qualify. So we will look at all that stuff. And it doesn't have to be like you're paying off an auto loan. Some folks have a lot of credit card debt. you really, maybe because your parents said always put 20% down, you don't want to pay MI, it's the devil, whatever. I think actually quite the opposite. I think it's much, easier to have a small fixed mortgage insurance and get rid of some consumer credit card debt. So we would look at all those scenarios. What can we do in the short term to free up your debt and make this much more comfortable for you?
Yeah, well, particularly with the delta between those two interest rates, right? Credit card debt could be well over 20%. And even though
Yes.
everybody's, distraught over our 6.5 to 7% interest rates right now, because they feel high compared to pandemic era rates, they're actually average rates for the life cycle of real estate, in recorded
Right.
history. But compared to a 20% rate, it's great. So all of a sudden you're looking at this payment, it blows your hair back. And we say, here's a bigger payment. But look what you just did. You freed up $500 and you moved debt from a 20% interest rate to a 7% or 6.5% interest rate. So you just made out in two different ways. And even though the payment is bigger, it might blow your hair back more. Your overall cost of living just came down. So it's a little counterintuitive on the face of it. But by playing with the numbers and looking at your individual situation for each client one at a time, we can help you make these moves that actually bring down your overall monthlies and move your debt to safer and lower interest debt in the process, which is win-win-win.
Right. And so, and part of that idea, and Rich, we've talked to people all the time that say, well, I have this debt, I have this and that. So I'm going to wait to buy a house, and I'm going to wait 6 months, or I might wait a year. Well, and I know you've done podcasts on this, Rich. What happens if you wait, right? How much better
Yeah.
off are you, or worse off are you? And so, um,
Yeah, yeah, it's an individual calculation for your market. If you're in an appreciating market, we're going to see 5% increase in home price, and you're waiting for a 1% decrease in interest rate. Those two things don't pencil. You're going to lose way more on the 5% that homes are going to go up in the year you're waiting than you'd gain by getting the 1% less interest rate. So I go through that for our markets in California. You can look, we have videos titled the Buy Now or Wait. And we actually have one coming up, refreshed one of that for 2025 coming up next couple of weeks. So make sure you subscribe to the channel if you want to see that one. But you can do those calculations for yourself in your own market. And maybe we'll do an episode walking you through how to do those calculations for yourself here in the future. But yeah, the idea is that these things are rarely as cut and dry as they look on paper. And so you can see there's only two variables we just taught you: property tax and homeowners insurance. And by getting those accurate and moving those around to the right numbers, you can see a wild swing in what you can afford, what your payment's going to be, what your outcomes are going to be if you've been estimating everything based on just the pre-programmed assumptions in these calculators. Now, maybe you're in a market in the country where a 0.5%, taxes is valid. I don't know where that would be, but that would be awesome. If you have that, that's great. Do backflips and leave the number. But for most of us, we're going to need, if you're in Texas, man, you're going to be changing this way higher, right? Property taxes are way, way higher.
yeah,
So depending on where you are, getting these numbers right makes a huge difference. And then going to a trusted professional with these numbers and saying, what can we do about this? How can we make this better? And that's where, if you're on we don't talk about this a lot, the difference between working with someone like Dave, who's a representative with a direct lender, you're dealing with a real person with 20 years experience, versus calling an 800 number with B of A or Wells Fargo, getting an hourly employee, has two loan programs to fit you in, and they're not walking through your entire financial picture to give you this kind of financial advice. Changes your outcomes wildly. Just that one thing, Dave saying, well, hey, tell me about your auto loan. How much do you owe on that? What's your interest rate on that? Let's move this number around. Boom, you pay this off. You save $500 a month. You also save interest. And now everything's more comfortable for you on your monthlies. You're not going to get that on an 800 number, loan line. That is the value of working with trusted professionals who have, spent a lifetime, or what feels at this point, Dave, like 3 lifetimes in this business, right?
yeah. And I think everything that you're saying, Rich, is 100% accurate. And I think the other piece here is, again, we always say this, everyone's scenario in this online mortgage calculator here that was pre-populated. We plug some figures in. These are just, random scenarios that would be unique to each individual that we would go through with you. And, we were talking about, I was talking about putting less money down. A lot of folks that are buying a home, and whether money's coming from gift funds for down payment, you've scratched and clawed and saved money, there's so many different scenarios where, I mean, you might have 30% down or more. And there might be a scenario where we say, hey, you're out looking at a property, or you scratch and claw, put 20% down. Let's put a little less money down, not only to pay off maybe some consumer debt, but leave some reserves in the bank for an oh crap factor. Or
Yeah.
maybe, or you look at the property, why do paint and carpet and some other things in a year? Do it right away. You got a little extra cash. And we're never encouraging you to borrow more than you should. But also, one thing I wanted to point out is the way, if we're looking at like a Fannie Mae or Freddie Mac backed loan, is if you put slightly less than 20% down, oftentimes the cost to get that rate is cheaper, because now there's a mortgage insurance piece. So that they're insuring, a percentage of that loan. So it's less risky. And now the cost to get your loan goes down a little bit. So there's some pros to that as well. So, we would again talk through all those situations and see what makes the most sense for you.
Yeah. And Dave and I are not financial advisors. I'm a residential realtor. He is a lender. And so this is not financial advice, but we do encourage all of our clients to maintain a healthy emergency fund. And so if raising your loan amount 10,000 keeps 10,000 in the bank, so that you are not tapped out on day one, so that you have money if a pipe bursts, so that you have money if you get an unexpected medical bill, that buys a lot of peace of mind. And so we have a much more nuanced and in-depth conversation with you about your personal finance. We were just having this conversation recently with a client about a buy down, probably because of the high interest rate environment. You all have heard of doing like a 3-2-1 or a 2-1 buy down, and looking at, well, okay, does it make sense to pay that money and get the advantage of the buy down? Or does it make sense to ask the seller to credit you that money, keep that money in the bank, pay the differential every month in the mortgage payment from those cash reserves? And then if you lost your job, you still have the rest of the cash reserves. Or if you had a medical bill, you still have the rest of the cash reserves. You have more flexibility doing it that way. So we have these nuanced conversations so that you can make the best decision for your family. We're not here to make the decisions. Those choices are above our pay grade. We just lay out all of the options and the pros and cons so that you as a consumer are really well informed. That's the name, the Informed Home Buyer Podcast. Is it weird to plug your own podcast on your podcast? Is that allowed?
I think it's allowed. Yeah.
But so you're really well informed and can make the best decisions possible. I think that's a good place to wrap this up. Go play with these calculators on your own. Make sure you're working with accurate numbers. Know that the tax number is going to be fixed, but that home insurance number is not going to be fixed. It'll bounce around depending on whether you're in a suburban, urban, or rural community. Go try these things out. And if you're having trouble, reach out to us. Our contact information is always in the description down below.
Yeah.
We can help you.
Yeah. One other note on that. If you do go to these online calculators, don't necessarily just use the rates that they're publishing there, because it's hidden too. That might include a couple points for a buy down, whatever that may be. If you are in a local market, reach out to one of your, local professionals. If you're in our market, obviously we'd love for you to reach out to us, and we can get your profile and tell you what your individual rate would be in lieu of you just using an online rate that's provided on the calculator right out the get-go. So you would know based on your profile what rate to use as well.
Great point. Yeah, because often too, these calculators are going to publish the lowest possible defensible rate they can to make things look better and more affordable, because a lot of them are just a sales inducement tool to try to get you to click through and give them some information. So yeah, that's a good point. Make sure you're working with an accurate rate for your whole credit picture. And that's something you can do within a 10 or 15 minute conversation with a trusted lender. Yep. Absolutely. Well, thank you guys again for giving us your time and making it to the end of this one. I hope this really helps you go out and use some accurate numbers, have accurate information to start to plan for your home buying journey. Whether you're ready now or you're getting ready, we're happy you're taking the time to get your own financial education, real estate education here with us. Dave, as always, thanks for being here.
Yep. Appreciate it.
We'll see you guys on the next one.